In this video, I'll be sharing an in-depth breakdown of the Forex market, what it is, why it exists, who are the key market players, to help you better understand how the Forex market works and the opportunity that exists for you as a trader and investor. Let's get right into it. So what is the Forex market? Forex refers to foreign exchange, that is, the exchange of two different currencies belonging to two different countries. So the Forex market is the market whereby the buying and selling of currencies actually occurs. Why does the Forex market exist? The Forex market exists to be able to facilitate trade between two different countries that hold two different currencies. It provides a global pricing mechanism to be able to understand whether, as an individual or company in a different country, whether you are getting value. So who are the key market players in the Forex market? Number one, central banks. Central banks are the issuers of currency, and their interest is in controlling the flow of money in an economy and ensuring that the value of their currency is not eroded significantly. Number two, companies. Companies that are engaged in the buying and selling of goods and services beyond the borders of their country need the Forex market to convert the money that they earn from the world or the money that they use to buy from the world from their local currency. Number three, banks. Banks help in the facilitation of global trade by being the intermediary that helps to exchange one local currency for a foreign currency or for converting a foreign currency into a local currency. Number four, hedge funds. Hedge funds use the Forex market to manage the risk in their portfolios to ensure that they can generate a competitive return for their investors. And number five, retail traders and speculators. Retail traders are interested in taking advantage of currency price movements to be able to make a capital gain on their invested capital. They do this by buying one currency vis-a-vis another and wait for it to either increase in value or decrease in value to be able to make their gains. So how does the Forex market work? Like any market, the Forex market is controlled by forces of demand and supply. What gets exchanged in the Forex market are currencies, that is, the currency of one country vis-a-vis that of another. Let's look at an example to be able to better understand this. Imagine we are in Germany, and on the demand side, there are flour importers that need to import flours from across the world and need about $1 billion to be able to do this. The problem, they have euros. On the supply side, imagine a car manufacturing company in Germany, let's say BMW or Mercedes, has just sold $100 billion worth of cars across the world. And they need to be able to convert their money to euros so that they can be able to use it in their country. So they both go to their banks to be able to help them to do that particular exchange. The bank will be able to sell dollars to the flour importers at a margin and buy the dollars from the car manufacturing company at a margin as well. The price movements in the Forex market are determined by the average price that the different market participants accept to buy or to sell a particular currency. Fundamentally, the strength of one currency vis-a-vis another is usually dependent on the value of exports vis-a-vis the imports that a country actually does. What this means, if a country buys more from the world vis-a-vis what they sell to the world, the value of their currency actually erodes. But if a country sells more to the world vis-a-vis what they actually buy from the world, then their currency becomes more and more stronger. But the other factor that determines whether a currency will actually go up or whether it will go down in value is the perception of the market participants. Based on the various information that is available on the different economies of a country, how the various buyers and sellers in a Forex market perceive that particular information will determine whether they will buy or sell that particular currency. And if there are more buyers than sellers in a particular Forex market, then the value of a particular currency will go up vis-a-vis another. But if there are more sellers than buyers in a particular Forex market, then the value of that particular currency will actually go down. So the opportunity that exists for traders and investors is that we are able to take advantage of these currency price movements to be able to make capital gains. And the additional benefit is that the Forex market is one of the markets that provides leverage. That means we are able to amplify our returns by using the broker's money to be able to make a return. Our only expense is the trading cost, but the returns are actually all attributable to us. In addition, the Forex market is one of the most liquid markets in the world. What this helps us is that we are able to get in and out of a market at any particular time that we want, because it is a market that has the highest turnover in the world. To learn even more about Forex trading and investing, check the recommended video on your screen. And for more trading tips on how to become a better trader and investor, then click on the subscribe button below. You will love the content. So see you in the next video.